Good morning, ladies and gentlemen, and welcome to the perennial webinar, Where to Find Value in Equity Markets During the COVID-19 Pandemic. I'm Cesar Farfan, your host today. I head up distribution at Perennial, and sitting next to me I have Stephen Bruce, who will be shortly presenting. He's our lead portfolio manager for the Perennial Value Australian Shares Trust. Stephen will touch on, amongst other topics, the outlook for the Australian equity markets, opportunities presented by the sell-off, stocks and sectors to avoid, and how the Perennial portfolio is positioned. Now, before I pass on to Steve, just some very quick housekeeping. You're all muted, which means you can hear us, but we can't hear you. Should you have any questions, we'll definitely attend to them. You have a dashboard in front of you, and on that dashboard, you'll be able to type in any questions in the Q&A panel. Just also important to note that in order to get your CPD points, you need to attend at least 80% of this webinar. Now, should you be unable to do that for whatever reason, we will be sending out slides and a recording of the webinar, and we'll have a short multiple choice Q&A which you can complete later on. Equally, feel free to share these with any of your colleagues. On that note, I will pass on to Stephen Bruce.
Good morning, ladies and gentlemen. My name's Stephen Bruce. I'm the Portfolio Manager of the Perennial Value Australian Shares Trust. Welcome and thank you very much for your time today. So today I'm going to talk about a few things. I'm going to start with looking at the current market conditions and also how we got to where we are. Then I'm going to talk about some of the opportunities that have been presented by this, and in particular, how we've been taking advantage of the downturn by adding some really good quality stocks to our fund. Then we're going to talk about some of the stocks and parts of the market that we're keen to avoid and where we see the risk and returns lying at the moment. And then in conclusion, we'll turn to the outlook and why we see really the strong chance of value-style investing delivering good relative returns from here. So let's get started. So where were we actually before the coronavirus crisis? And well, the reality was that things were actually on the up. If we look back to the latter part of 2019, what we saw was that global economic conditions, they were basically getting better through the year. And this was being driven by a group of macroeconomic factors which were sort of turning for the positive. If we looked at the US, there was strong growth. The trade tensions with China were easing. The Brexit impasse was being resolved for better or for worse. And there was an ongoing low interest rate environment. And all of this was supportive of growth. And then on the domestic scene, we were seeing a modest upturn in activity. Interest rates had been cut. That was flowing through to the property market. And it looked like the gentle inflection point that the government and the RBA had been trying to engineer was being achieved. And on this slide here, we show a chart which is the OECD leading indicators for the major economic regions. And what you can see here is that towards the back end of 2019, while things were still negative, they were starting to trend back up in a positive direction. And this is really important, I think, because in a typical downturn, it's caused by big macroeconomic imbalances. For example, if we just think about the GFC, you had a huge build-up of subprime debt and the excesses related to that. That debt was never going to get repaid. You had to have a downturn to purge that and work through that. Similarly, in a typical recessionary scenario, you've had an overheating economy where the central bank moves in, raises interest rates and slows the economy down, hence you get a recession. And these take a prolonged period to work through. Whereas what we've got today is something very different where the underlying economy was on an improving trend without excesses, and then you've had this exogenous shock which has hit the economy. So things were going quite well till, of course, this happened. Now, I think we all agree that in the scale of black swan events, this is certainly a very, very big black swan. And I think if there's one thing that will come out of this, it's really woken up everybody to the importance of thinking about resilience and leverage when they're thinking about their investment portfolios and in fact, their own personal circumstances. But, we're taking a fairly optimistic view of this, and when we look around, we do see some reasons to be positive. Firstly, infection rates are stabilising globally, and we can see this on this chart here from the WHO data, where we're seeing declines in Europe and are sort of peaking in the US. So overall, we're hoping that we've probably seen the worst at a global level. Closer to home in Australia, again, well, it seems the lucky country has got lucky, yet again, through a combination, again, I think of, which is typical of here, good management plus good luck being an island. You can see there are next to no new infections occurring in Australia, and that sets us up well to get a loosening of restrictions, probably ahead of other regions of the world. And then finally, we'd say it's the best news of all, in terms of the number of people who've got sick, well, the number of people who are still sick is very, very small, and virtually everybody is seeming to get better, which is very positive. So what does all this mean for markets? Well, clearly the markets have sold off aggressively from their highs in February, with the ASX 300 down nearly 25% from the peak. But if there's one thing about sell-offs, it's that they really create opportunity, and the near-term uncertainty, which is very, very real, we believe is creating equally real long-term opportunities. And this is where we believe that you can add real value as a long-term investor and take advantage of times like these to set up your portfolio really well for the years ahead. So if we sort of think about some of the steps we've been taking in our portfolio to take advantage of this opportunity, I've just listed on this slide here a number of the changes that we've been making through this sell-off period. And what we've essentially been doing is we've taken advantage of the sell-off, which has at many times been really quite indiscriminate. Good stocks have been sold off just as much as bad stocks in many cases, and we've taken advantage of this to add what we think are high-quality stocks which have above average rates of growth and above average quality, for want of a better word, and add those to the portfolio at prices which make them really value stocks. And just to pick a few examples here, City Chic Collective, it's a women's fashion retailer with a very strong growing online offering and a very strong growth option in the US. It's a small stock, not that well known, X100, sold down dramatically, and that gave us an opportunity to buy into that stock, where we still believe it has more than 50% upside on a medium-term view at an attractive price. We also added another name, Smart Group, a leader in salary packaging. We've increased holdings in stocks like Hardee's and Aristocrat, and these are stocks which have global leadership positions, have organic growth that's not entirely dependent on market growth as they take market share, for example. Other examples, PWH Holding in the sort of automotive cooling industry, and then at the larger end, we've added some holdings like Goodman Group and Magellan to the portfolio, very high quality businesses which were sold off sharply and gave us great entry points. So we have been very active in this period, taking advantage of the sell-off to add high quality stocks to the portfolio, but at very attractive prices. When we look at how the portfolio is now sitting at a thematic level, if we break down some of the holdings into sort of key categories and look at them at the high level, on the left you can see it's good to have companies which have these strong global leadership positions. Aristocrat and James Hardie fall into that category, and we'll talk about those in more detail later. Similarly, we're quite positive on the large cap resources, iron ore in particular, where the price has held up strongly, and we know that in an environment where growth is challenged, the Chinese have a propensity to stimulate, and that's positive for our bulk commodity exporters. Related to the mining sector is mining services, and these are the companies that provide engineering and other services to the mining sector. Now, part of the attraction of the resources sector in recent years has been very well controlled capex, which turns into good cash flows, but they're now at the point where they do need to start increasing some spending, and that's going to flow through to the earnings of their service providers, companies like Monadelphous, Worley and Seven Group. Then in the diversified financials, which is a very varied bunch of companies, that we do see some good opportunities. Macquarie is always the standout with its growing asset management business, and if there's one thing that we know about Macquarie, they never waste a good opportunity. Then talking about stocks which sort of move to their own beat, the macro uncorrelated stocks, and here we have a number of agricultural stocks, and one of the things that's a positive change in the economy at the moment is after years of drought, the outlook is really improving for the agricultural sector. So stocks like New Farm and Grain Corp fall into that category. And then gold as well. When you're looking around the market for defensive stocks, many areas of the market which are defensive are also very expensive, which causes us to shy away. And we actually think gold stacks up well for a number of reasons if you're looking for a defensive exposure. So let's dig a bit deeper and look at some specific stock examples. Now, Aristocrat Leisure, now that's one of our key overweights in our portfolio. It's a stock we made a lot of money on through the last 12 months, significantly took our profits, but then we've had a second bite of the cherry with the sell-off that we've seen here. So we've reweighted back into this stock. Now, we're all familiar with Aristocrat as being the maker of Queen of the Nile and other iconic gaming machines like that, but the business has really evolved from what a lot of us would remember it being. And they're now amongst the top 3 gaming machine manufacturers in the world. One of the positive changes is they've gone from a model where essentially they were just shipping boxes to casinos and venues and collecting a check to actually running on an annuity style revenue share model, which really increases the quality of their business because they're not so reliant on how many sales are we going to make this year. They go into each new year knowing we have X thousand machines installed that give us around X dollars revenue a day, and that has really increased the quality of the business. Another big change in the business, and this is a really relevant thing for where we're at today, is their growing digital business. So you can see almost a third of their revenue now relates to online, and that's essentially online versions of their traditional games, but also what you might think of as your normal video gaming business. And when people are locked at home, well, that's a part of their business which is likely to be growing strongly. And this is another really important point about Aristocrat is I said it was one of the 3 major global gaming companies. Now, it's got a very strong balance sheet, and if there's one thing that we've learned in this downturn is that balance sheets are absolutely critical. And even companies that we thought had strong balance sheets, many of them with the extreme nature of this downturn and the sudden shocks to revenue have found themselves in trouble. But Aristocrat is one where we're confident that the balance sheet is very sound. And if you look at their global competitors, they went into this downturn with very, very high levels of gearing. And what that's meant is, other than the fact that they're plainly going to be in financial distress, it means they're just not going to be able to invest at the same level as Aristocrat to continue to compete. So Aristocrat will come out of this downturn in an even stronger position in our view. So I've talked about why we like the company from I guess, a fundamental view, but let's just have a look at the valuation point of view, which is the other half of the equation and always equally important. Now, on the bottom right of this slide, we have some metrics here. So this is a stock, because it's a high growth, high return, high quality stock, which typically trades on around 20 times earnings. At the moment, on our expectations of the earnings 2 years out, when there's been a recovery in earnings, which we would expect, the stock's now trading on a bit over 13 times, 13.5 times. We're expecting this business, given its underlying growth characteristics, to do double-digit earnings per share growth over the next number of years. And so you're paying 13 times for something that's growing at 11 times. So it's almost only a bit over a 1.2 times ratio of the growth you're getting for the PE you're paying, which is really quite a low ratio. And then another really simple way of looking at the upside in the stock is to say, what is the multiple it's on now? What is its long-term multiple? And its long-term multiple, 20 times, a simple re-rating of the stock gets you near 50% upside. So it doesn't require any heroic assumptions about earnings growth. It just essentially makes you assume that the earnings growth gets back to sort of where they were before this crisis over the next couple of years, and then we get a re-rating back to where we were, and you've made 50%. And you can take comfort in a stock like this, knowing it's a quality business with a good balance sheet, and it's the sort of opportunity that as a value investor, we're on the lookout for all the time. Another stock which falls into a very similar argument is James Hardie. Now, James Hardie, we all know them from Hardie Plank in Australia. It's a global business, and in the US, they don't use nearly as much Hardie Plank as they use here. So not only is it tied to the housing cycle, and one of the things that we would expect coming out of this downturn is that there will be stimulus, etc., which means stimulus plus low interest rates, which means the housing cycle should be strong. But they are taking market share off other forms of siding, vinyl in particular. So not only do you get market growth, but you also get market share gains. And as a consequence of that, if I look at the similar analysis that we did with Aristocrat, what we see is because of these good qualities, it's a stock which is generally traded on a long-term average of around 22.5 times earnings. Now you can buy it for less than 16 times earnings. Again, the ratio of earnings growth that we're expecting to the multiple we're paying is again a bit over 1, a relatively cheap multiple. And on a similar analysis around the re-rating upside, again, over 40% upside simply from a re-rating. And then on top of that, they've recently acquired a business in Europe, a building materials business called Fermacell, and that is essentially going to be an entry point into Europe where they expect to be able to cross-sell some of their other products on top of that platform. So the business before this downturn was performing very well. The last results reported in February were very strong. We think it has a fabulous market position, a decent balance sheet, and will continue to grow well. And it's one of these sort of stocks where we see a lot of medium-term opportunity, and a sell-off like we've had today, over the last couple of months, has given a really great opportunity to establish a position, or actually re-establish a position in that stock, having also made good money on it over the last year. So moving on to the financials, and I talked about Macquarie before. Macquarie's almost been a core holding in our fund for many, many years, and there are so many things to like about Macquarie. At the moment, it's on what we think is an attractive valuation, having been sold off quite hard. Now it's rallied a little bit since we made this chart, having delivered a result which was actually pretty good, and we think very conservatively couched. So the FY20 result, they have a March year end. They delivered that a week or so ago, and they took the opportunity to take about $500 million in credit impairment charges just in case. Now, these were spread pretty evenly across the 5 divisions of the business, which to me suggests it was more a conservative move rather than anything else. And there's one thing we know about Macquarie: they never waste a good crisis. After the last downturn, they built a whole new business called CAF, which is essentially based on using cheap government money to buy distressed debt, out of which they made billions of dollars over the next decade. And in this environment, they've gone into it with a strong balance sheet, and we're confident they will be acquiring assets over the next period at very attractive prices, which they will then realise big gains on over the coming years. So in a way, this is an opportunity for them to restock the larder, if you will, of assets which they can generate profits on over the next number of years. And that's sitting on top of really, the real attraction of this business, which is the strongly growing mirror business, which is infrastructure and real assets, where they're the world's leader in funds management of unlisted infrastructure assets. And we all know that is an area of the market with essentially, I won't say limitless, but massive upside. There's far more money chasing investments in that space than there are assets to invest in. And Macquarie have the advantage of being in a way fully integrated, such that they can originate assets from greenfield sites and make them available to their funds. So again, the adaptability and strength and excellent management of Macquarie gives us confidence that it will perform very well going forward. I mentioned resources before. Now, resources obviously are very cyclical as a sector of the market, but ironically enough, when we look around, resources give us some of the most reliable earnings at the moment. The iron ore price remains resilient. We know that China is likely to stimulate. There's a People's Congress in 2 weeks' time where there may be some announcements, but either way, when you do look at the data, there is increasing spending, increasing borrowing, and activity in general is picking up in China. So, infrastructure investment and building has their tried and tested way of boosting growth, and that necessarily is positive for BHP, Rio and Fortescue, etc. Now, the other really critical thing about the resource stocks at the moment is as a result of generally strong earnings, controlled capex and some asset divestment where they've been slimming down their portfolios and getting rid of non-core assets, is their balance sheets are in super strong shape. And on this chart here, we've just shown some charts taken from the BHP and Rio most recent reports, where what you can see is their gearing levels, how they've fallen over the last number of years and are now sitting at the bottom of their target ranges. And what that means is obviously, as well as them being financially very resilient, it means they're in a good position to pay dividends. And that's particularly important in an environment where dividends across the market will be lower. So for dividend-seeking investors, resources do present an option at the moment and potentially on the medium term as well for replacing some of those bank dividends which have been cut. And then when we look at the pure valuations on the bottom left, the multiples being factored in on these stocks are not demanding in the low single digits with an attractive dividend yield. And while we're on resources, energy's been a very interesting sector. The oil price has been hit extremely hard. It started out as a geopolitical issue between Saudi Arabia and Russia, arguing about how they would cut a few million barrels a day. Then, of course, the coronavirus demand impact kicked in, and that's more like, how do we cut 30 million barrels a day? But what we can see from this chart here, which going back 20 odd years, is that the oil price simply does not stay at this level for long. And the reason for that is at this level, nobody is making money. And it is by definition, it's an unsustainable level. Supply demand will come back into balance and the oil price will rise. Exactly where it rises to, of course, is hard to say. It will not be $100, but it's probably going to be closer to 60 than 30. Now, the important thing is in the meantime is knowing that your energy exposures are able to ride out the storm. And when we look at the key exposures in our portfolio and the Australian market, being Woodside, Origin and Santos, they all have low production costs, and so they're not burning cash, and strong balance sheets to carry them through this period. They've all been very proactive in reducing their operating costs and deferring capex and growth projects to protect their balance sheets through this period as well. But in the meantime, it's important to remember that while low oil prices are bad for oil companies, and oil companies in many markets are significant parts of the overall index, so that's not ideal for the stock market in some cases, it's very positive for consumers. So effectively, this is like a tax cut across all manufacturers and in industries and consumers. So net, it is a positive to the economy. I mentioned gold before. Given how expensive and in many cases geared lots of the defensive sectors of the market are, and here I'm talking about healthcare where the multiples are extraordinary, and infrastructure where, infrastructure hasn't actually proven to be that defensive if you look at the share prices of Transurban and Sydney Airport, and it is certainly highly geared. When we're looking for a genuine defensive, gold actually stacks up quite well for us. And what we see on the chart here, the yellow line shows the Aussie dollar gold price and the white line shows the gold index, so what the gold stocks have done. And you can see they were tracking along together until coronavirus hit. And then what you had was a phenomenon where investors were forced to raise cash, we believe, and started selling everything that hadn't gone down. And that involved significant liquidation of gold stock holdings and gold ETFs. And that's why you saw the precipitous drop in the white line there early on, despite the fact that the gold price had continued to rise steadily. Now, part of that has recovered, but we still think it has further to go. And when we look across our gold holdings here, we have Newcrest, obviously the big one, but we also have some second-tier miners, Northern Star and Santa Barbara, for example. And then finally, Perenti is a mining services company that services the gold mining sector, so it should do well on the back of the general strength of the gold industry. And when we look at all those companies at the fundamental capital level, we see companies that are generating very high cash operating margins with the Australian dollar gold price being so firm. They've all got strong balance sheets, and the smaller ones are actually in net cash positions, and they all have production growth options. So we're quite happy to be in the gold sector at the moment and see good opportunities for capital growth there. I mentioned agriculture before, and the beauty of agricultural stocks is that they really march to their own tune, and they've had a terrible time the last few years, but just in a nice counter-cyclical way. You know, it started raining 3 months ago, so the setup for the coming winter cropping season is absolutely fabulous. Our GrainCorp just reported its result today. It was a very poor result as a consequence of the drought of the last few years, but they sort of confirmed that the outlook for the coming season is very, very good. So we've got some holdings in this space. GrainCorp and Nufarm, these are stocks where we actually see more than 50% upside in these stocks, in the sense that they're both recovering from cyclical earnings lows. They're both operating in industries where there's significant consolidation, and they both have some stock-specific attractive features. In the case of Nufarm, not only does it have a very significant global distribution platform, which could be of interest to many other on-patent crop protection companies, but they also have some very exciting proprietary omega-3 canola technology, which is essentially where they're using genetically modified canola to produce omega-3 and not have to get it out of fish. And that is a very potentially big and profitable market and environmentally very positive. And then GrainCorp has this huge portfolio of assets, including 7 ports up and down the coast, which are clearly undervalued within the GrainCorp structure. So potentially there's some corporate angle there as well. But in the meantime, the simple fact that the drought is over and the outlook for the agricultural sector is improving, we think should make these stocks perform well. Now, finally, I'll get on to the banks. There'd be no discussion of the market without a discussion of the banks. Now, the banks, as we all know, have had a torrid time the last number of years between the Royal Commission and various other pressures that they've had on them. But I think this could ironically be an opportunity for the banks to really demonstrate the value of Australia's strong financial system. And I think this is something that gets really overlooked in all the attacks in the press and the politicians. I mean, if you have an economic downturn combined with a financial crisis, you get something really, really bad. We've managed to avoid that in Australia because our banks have always been strong, and that has been of great benefit to us. And this is going to be the case in Australia as well this time. If we just look at the table here, which is conveniently done by Jeffries, it just shows you, there's a whole lot of data here, but what it's pointing out is if we go back to the last downturn and then compare to now, the banks are just stronger at every level in terms of the amount of liquidity they hold. They've gone from 5 days of liquidity to 30 days of liquidity. What counts as a liquid asset now is a far higher quality asset than what they used to be able to hold. Their funding, and ultimately a bank comes down to its funding base. That is the number one thing of banking. What is your ability to attract and retain funding? That is key to running a bank. And if you look now, the deposit to loan ratio has improved. The reliance on short-term wholesale funding has decreased dramatically, and they're backed up by the government as well. So on every metric, the level of capital has almost doubled over the period. The risk weightings that they're applying when they're calculating that capital are higher. So the banks have gone into this in a very strong position. So the three of them, ANZ, NAB and Westpac, all reported their first half results a couple of weeks ago, and CBA did its third quarter trading update yesterday. What we saw was that they've all taken large increases in their provisions preemptively to get ahead of the expected bad debt cycle that we're going to see come through as a result of coronavirus, and they've reduced or suspended their dividends to conserve capital. Now, that was a bit of a surprise to the market, and it was sort of went contrary to what the regulator had initially been recommending they do, but ultimately it probably is a prudent step. And speaking to the banks, I was just speaking to the CEOs of one of them yesterday, when we get to the latter part of the year, and they'll be reporting their full year results in November, there should be significant more clarity one way or another at that point on the outlook, and therefore about the reinstatement or catch up of dividends. Now, our view on the banks is that when we look at them, we see some clear medium-term valuation upside, particularly in ANZ and NAB, which are trading at material discounts to their book value. However, when we do see them facing some near-term headwinds as the uncertainty about just how deep or not deep the bad debt cycle pans out to be. So essentially, we're holding a close to index weight position in the banks. It's just we see other parts of the market having the potential to deliver better returns ahead of the banks. But fundamentally, we do think the banks will do well in this period and recover. So when we put all that together, what does that all mean for our portfolio? So we see a really good value in the portfolio, and we've been able to put good quality into the portfolio at good prices. And the way we assess the overall valuation in our portfolio are by these four metrics here that you can see. So we look at the price to earnings ratio of the portfolio, the price to cash flow ratio of the portfolio, the expected gross yield on the portfolio, and the price to book value of the portfolio. So four different metrics that tell you four different things, but they all are different ways of assessing value and relative value. So here we're looking at FY22, so 2 years out across the valley, if you will. And what we see is we're buying a portfolio which on most metrics is on around a 20% discount to the market. And it's a portfolio which, despite being on a discount to the market, is comprised of stocks which we think are of high quality and have high potential to deliver really good returns. So turning to the outlook, now obviously the level of uncertainty here is just off the charts, and my view of the outlook is no better than yours or anyone else's, but you have to have a view. So the base case that we're running on is that April is about as bad as it gets in terms of coronavirus infections, and by the time we get to the end of May, there's going to be some clear positive trends, and we're starting to see, some evidence of that. So this is going to result in a sharp global downturn in the second quarter with the lockdowns in place, but again, we're starting to see some easing there. We're expecting activity to ramp up through the third quarter, and then by the time we get to the fourth quarter, hopefully we'll all be going off to Christmas with everything getting back on track. So what that means from an earnings point of view for companies is that the second half of FY20 in Australia, the first half of FY21 are going to be a mess. But then when you're getting through to the second half of FY21, things are going to start looking better, and FY22 is going to be a clean year. And that's why when we're assessing value, we're trying to look at that clean year underlying what's 22 going to look like. And then, I guess the thing that gives us some confidence is when you look at the extent of stimulus that has been thrown at this downturn between fiscal stimulus, monetary easing, and legislative actions around rent and etc., it's really been unprecedented. And we think that this has a good chance of succeeding and protecting a lot of businesses through this period. And in that case, it will also protect financial markets. And then we think Australia is going to do better than the rest of the world. And that all leads to us to believe that there is significant upside in our portfolio. So just touching on the Australian outlook again, and the lucky country, I think we're just going to demonstrate that again. Good luck, good management. We've done a good job of containing and controlling the virus with the infection rate approaching zero at the moment. Our resources sector that we've relied on for so long, again, is looking like it's continuing to be strong and will support us. The banks, they're in a strong position and they're well positioned to play their part in helping the country get through this. Ag sector's looking better. The government went into this in a good fiscal position. And then tourism, just to pick another sector to talk about. Now, this isn't a big sector in the listed market because there aren't really that many companies. There's, I guess, the casinos and event hospitality, but not too many large tourism-exposed listed stocks, but it's an important part of the overall economy. And this little chart here, it actually shows that Australia is a net importer of tourism. Now, we always talk about how important tourism is as part of the Australian economy, the money we make from overseas visitors coming here. but we actually spend a lot more money going overseas on holidays than people spend coming here. So if we find ourselves, and this is quite possible, in a situation where we're allowed to go on holidays locally, but we're not allowed to go overseas, well, the potential for money to be pumped into the economy that way is really significant, and that could give a massive boost to the economy. So let's move on to valuations, and this is really important, and we've probably pointed this out before, but growth stock valuations are at absolute record levels. They're off the charts, and this chart here shows essentially the PE premium to the market that the most expensive 20% of stocks are trading on. This is produced by Goldman Sachs, and what you can see is we're at record levels. Now, this is the crowded trade of people piling into growth and momentum over the last number of years, and this has only accelerated in the last little downturn. Now, of course, you never know when this is going to change, and you never know what the trigger is going to be. But what we do know is that history shows when valuation dispersions are at extremes, mean reversion kicks in almost like a force of gravity. We saw it in the tech wreck at the beginning of this chart. We saw it in the GFC in the middle of the chart. And I think there's a good chance that at some point we're going to see it at the end of this chart. And if we just want to use an example of this sort of extreme valuation of certain stocks, I think CSL is a really good place to start. Now, I love CSL. It's a fabulous business. It's probably the best business in Australia. It's extremely well managed, and there are a lot of things to like about it. However, the bottom line is no matter how good a company is, if it is extremely highly valued, the risk-reward skew starts to turn to the downside. Now, I cover healthcare stocks, so I could give you a very long list of the positives of CSL, but I could also come up with quite a long list of risks around CSL over the short, medium, and long term as well. And the point is that, yep, there are positives and negatives, but you have to ask the question of what is being factored into the price. Now, CSL is trading currently on consensus numbers of FY22 of 37 times earnings. Now, that is 2.3 times or 236% premium to the market. If you look over time, the average premium CSL trades on is 160%. So yes, it always trades on a premium, it always trades on a big premium, but the premium it's trading on today is massive by its historical standards. And is it delivering higher growth than it used to? No, it's not actually delivering higher growth. In fact, the EPS growth that it's delivering is really not that much higher than the EPS growth we're expecting out of Hardee's or Aristocrat or a whole bunch of other stocks. Sure, it may be a bit more reliable and it is a very high quality stock, but we think at these sort of levels, a whole lot of good news is factored into the price. And even if you say, okay, earnings expectations are met, they do what they say they're going to do, they do what the market expects them to do, a simple de-rating back to your long-term PE, which is still a very generous PE, could see 30% downside in the stock. So we're just making the point that, yes, good companies deserve a premium, but you have to look how great is that premium, and when the premium is really, really high, and you can see why it gets high because people are scared, it's a risk-averse environment, people fly to quality, but when the premium is high, the risk-return going forward starts getting skewed against the investor from these levels. Now, the flip side of all this, what's been happening in the last number of years and what you saw on that chart of how expensive the expensive stocks are, is that the value stocks have really been left behind. And this chart here, this is called a factor heat map, and it looks at the different style factors of investing. It looks at some of the valuation metrics that value investors look at, and quality metrics and momentum metrics and growth metrics. And very simply, going back over 5 years, and what we can see, red means bad, underperforms, blue means good, outperforms. Going back for a number of years now, it's been one-way traffic where quality growth and momentum have been outperforming value. And, with low interest rates and low growth environment and all of those arguments, which we know around why that's been the case. But the reality is the result of that is that there's this overcrowded, expensive, overbought trade in growth and momentum stocks. And what we saw, if you just look the last month sector, so this is the April returns on this chart. In a month where the market took a turn for the positive and had a rally off the bottom, value started to outperform. at the back end of 2019, where the economic outlook was starting to improve, we had several months where value outperformed. So I think it clearly shows that in an improving environment, value is poised to perform really well. And the perfect example of an improving environment would be a post-coronavirus recovery. So we believe that value can perform really well once we pass the worst of coronavirus and the market starts looking across the valley to a return to normality. Now, we know that value investing works over the long run. I'm sure you've all seen this chart from Schroders, which shows that you have these brief periods of underperformance, but in the long sweep of history, value performs very strongly as a style. And at Perennial Value, we pride ourselves on remaining true to label value. So we don't style drift. We've stuck to our guns, and we want to give people a value exposure that they're hiring us for. And what we can show here quantitatively, and this again is something that Goldman Sachs produce, it tracks the relationship between the performance of our fund with the performance of the value factor. So if you look at the shaded areas, essentially all the funds in the market, and the blue line is the Perennial Value Australian Shares Trust. So you can see we're consistently tracking amongst the most true to label value of all the funds in the market. So if you believe that you can have a recovery in value at some point, we believe that our fund will give you leverage to that. And value has been proclaimed dead many times, but has always bounced back. And here we show the outcomes after the last two downturns in value. If we look over the 97 to 99 period, which was leading into the tech boom leading into the tech wreck, the following 12 months after that, our fund delivered double-digit alpha. Then similarly, following the GFC, the fund delivered double-digit alpha. And these were both in periods where there's all talk of paradigm shift, new realities, etc., and how value investing would never deliver alpha again. Hasn't been true in the past, and we don't believe that it's true now. So to summarise, we know value has underperformed in recent times. However, it has outperformed over the long run. And it outperforms. Now, this is important. It outperforms when growth doesn't. So if you're thinking about portfolio diversification, having some value in your portfolio provides you diversification. Growth has done fabulously well. Momentum has done fabulously well. But, maybe it's time to take some profits in those and then rotate into value to give yourself a hedge should things change. We know that valuations are at extremes now. The valuation spread between growth and value, the absolute valuation of the growth part of the market. And we know that history shows that a precondition for value outperforming is for valuation gaps spread to have got to an extreme, and this is the case now. And then we know that value, as I said before, outperforms in an economic recovery scenario, which is what we would expect in a post-COVID environment. And then the final point is, we know all the arguments in favour of growth around falling interest rates, etc. But surely we're getting to the point with interest rates where they are now, bond yields close to zero, that we've really seen the most there is out of that tailwind. And ultimately, whether you buy, no matter how good the growth stock you're buying is, you do require an equity return. And so we think we've hit the point of diminishing returns on that trade. So really, maybe this is as good as it gets for growth stocks. When we look at our portfolio, we see there's this massive upside in individual stocks. And then we've really taken advantage of the sell-off to opportunistically acquire very good quality stocks, but only have to pay very good value multiples for them. So in conclusion, this current situation that we're all living through is, of course, totally unprecedented. But similarly, the government response here and globally has also been unprecedented. Importantly, as I said at the start, this downturn's been driven by external factors rather than built-up imbalances, which have to be worked through, and we think that this means a rapid recovery is possible. Australia, again, is well placed in this situation, and sell-offs like these really create outstanding opportunities. And as I said, we think everybody needs some value in their portfolio. So thank you. That's the end of my presentation, and I would be happy to try and answer any questions that people may have.
Steve, Caesar again, thank you very much for a comprehensive presentation. You've definitely made a great case to be aware of the risk of it being underweight value. Perennial has lived through both the tech wreck and the GFC. This year is the 20th anniversary of the Perennial Value Australian Shares Trust, and we've certainly seen these PE dispersions collapse in the past. Clearly, the market's underweight value as well, but we've seen a turn in that the last 6 to 12 months, with many more retail and institutional investors speaking to us about value. We have a few questions here. I might try and consolidate a few in the interest of time. Basically, I've got 3 questions here that are asking the same thing. How bad is this recession? And do we have, how much more downside do we see in the markets? I know it's a tricky question, but maybe if you can just comment briefly, Steve.
Okay, I guess so. So how bad is this recession going to be? Well, I think I'd get back to the point I made before, that this recession is being caused by a short, sharp external factor. It's not being caused by a decade of imbalances that have built up and are going to take years and years to work through. So I think potentially this could be a very sharp and very short recession. And if you use the sort of stock market as a proxy, I'm not sure if people have seen the charts. I didn't put one in, but if you look at all the way the stock market has responded in all these previous downturns, the stock market has fallen this much, but over 2 years, progressively dribbled down, whereas it's pretty much been a precipitous fall this time. So potentially, I think that's the market factoring everything in quickly, but also potentially factoring in that this could recover quickly.
Thank you, Steve. There's a question on banks, but I think you addressed that well in terms of our neutral position, and the banks do seem to be well capitalised. Could you just briefly comment on April? So March was a tough month for markets, but we saw a strong recovery in April, and also the strategy doing very well.
No, that's right. So March was just what we'd call a total sort of capitulation, where everything, good, bad or indifferent, got hit hard. Value stocks, typically being more cyclical, got hit harder. But then I guess the market bottomed in late March, and then began rallying, and then the rally continued through April, which was up, and the market was up like 9% in April. What we saw was, I guess, the market being sifted through, and a lot of the stocks where there'd been what you might have called panic selling in March started to have a bit of a rally in that period, where things had been just really oversold, and the fund did well. So we added 270 basis points of alpha in that period. But that was when the period that we've been really actively adding new things to the portfolio.
Thanks, Steve. I have another question here. What impact do you see China's trade fight having on the likes of resources and agriculture?
Yeah, I mean, it's horrible timing, isn't it? Just when the crop's gone into the ground and it's going to be a massive crop, that this has popped up. I think the reality of trade fights between Australia and China in the past haven't been that significant. I mean, they happen from time to time, but at the end of the day, China wants Australian iron ore, and that's that. There's only 2 places you can really get it, Brazil and Australia, and neither of those places are producing at excess capacity at the moment. So they're going to keep buying our iron ore, there's no doubt about that. And then they have their own considerations really around agriculture. I mean, they have people who like buying stuff at the supermarkets, and I think this is just a short-term political thing that'll be more than likely passed over soon. And when you sort of think about, as I understand what's happening with improved pasture conditions, people probably aren't racing to be turning livestock off the land to the extent that they have a lot of livestock after the drought, and then the grain harvest isn't going to really be till October, November, and there's a fair bit of water can go under the bridge between now and then, and all of our export stores are empty anyway. So
thank you, Steve. We've probably got time for one more question. Have all the imbalances of the last correction actually been worked through? And I assume the last correction being the GFC.
I think if you sort of look at it in sort of various sub areas, for example, after the last correction, where probably if there was one biggest imbalance in the world, it was the US consumer debt, consumer housing debt. Well, that has been worked through. If you look overall in the world, obviously debt levels in aggregate everywhere are higher than they ever have been, and that is the thing that overhangs the world economy and has for a long time. And it's a question that everybody keeps asking, well, surely this must stop at some point and this must cause a problem at some point. And no one knows the answer to that, but it doesn't seem to be causing a problem at this point, in the sense that central banks seem to be able to be printing money at the moment, keeping interest rates as low or negative as they like, without stimulating either inflation, hyperinflation, or any other major issues. Now, whether that's just around the corner, I don't know, and probably nobody knows, but at the moment, it seems things are okay.
Excellent, Steve. Look, on that note, we might just wrap up. Ladies and gentlemen, thank you very much. I'd like just to leave a few key points with you. Obviously, you've heard Stephen's presentation. With the Perennial Value Australian Shares Trust, clearly you have a very well diversified portfolio with companies that have very strong earnings per share growth, solid yields, and most importantly, very attractive valuations. So beware of the risk of being underweight value. Our investment team are more than happy to speak to you and your clients. In terms of housekeeping, yes, we will be sending you those CPD certificates very shortly, as well as a copy of the slides and a recording of the webinar. So on that note, thank you very much for joining us again. Enjoy the rest of your day and stay safe. Stay safe. Bye.
Thank you.